Imagine waking up one morning, logging into your bank account, and seeing a big fat zero staring back at you. Your life savings, gone. Years of hard work, wiped out overnight. Scary, right? Well, this isn't just a nightmare scenario. It has happened countless times to people who invested everything in one place, only to watch it all vanish due to a stock market crash, economic downturn, or even a scam. But here's the good news. You can prevent this from happening to you. In this video, I'm going to show you exactly how to build a bulletproof, diversified investment portfolio, one that grows your wealth while protecting you from major financial disasters. By the end of this video, you'll have a step-by-step investment strategy tailored to your age, risk tolerance, and long-term financial goals. This is the same wealth-building strategy used by some of the richest investors in the world. So stick around and learn how a right investment can save you. So what is this diversification? Think of diversification as your financial safety net. If you put every dollar into just one stock or even one type of investment, you're essentially gambling. One bad market crash and you could lose everything. But if you spread your investments across different assets, industries, and regions, you reduce your overall risk. Let's see the power of diversification with two historical stories. First one, during the 2008 financial meltdown, the stock market tanked. Some investors lost over 50% of their portfolio value. But those who diversified their investments into bonds, gold, and real estate suffered much smaller losses or even made gains. For example, gold prices skyrocketed as investors sought a safe haven. Bonds provided stability while stocks crashed. Real estate investors who focused on rental properties still earned passive income. One of the few investment strategies that held strong was Ray Dalio's all-weather portfolio. We might create another video just on this strategy, but to give you some background, it is designed to perform well in all economic conditions, including periods of growth, inflation, deflation, and recession. The strategy aims to balance risk and reduce volatility by diversifying across multiple asset classes, such as stocks, bonds, commodities, and inflation-protected securities. Now another story, the dot-com bubble disaster in 2000. Back in 2000, tech stocks were all the rage. Everyone was pouring money into Yahoo, Pets.com, and AOL, thinking they'd become millionaires overnight. Then the bubble burst. Some stocks lost over 90% of their value. Many investors who were all in on tech lost everything. Meanwhile, those who diversified into bonds and value stocks recovered much faster. The lesson? Never put all your money in one type of investment. Your age is one of the biggest factors in shaping your investment strategy. Why? Because financial goals and risk tolerance change over time. Here's a smart investment breakdown based on age groups. If you are in your 20s or 30s, it is a high growth mode. First, ensure to have an emergency fund of at least 3 to 6 months of expenses. Stocks, making up 80 to 90% of your portfolio, you should focus on growth stocks like Tesla, Amazon, and emerging markets. Bonds at 5 to 10%, it will provide some stability. Real estate also at 5 to 10%. Other investments up to 5% can include crypto, startups, and commodities. This is the time to take bigger risks because you have decades to recover. If you are in your 40s, you have to balance between growth and stability. First, ensure to have an emergency fund of at least 6 to 12 months of expenses. Stocks, at 60 to 70%, should shift toward blue chip and dividend stocks. Blue chip stocks are shares of large, financially stable companies with a strong reputation, steady growth, and often reliable dividends, like Apple and JP Chase. Dividend stocks provide investors with a regular passive income. Then, bonds at 20 to 30% offer more stability. Real estate at 10 to 15%. Other investments, up to 5%, can hedge against inflation. In this age group, you still want growth, but with more protection. If you're in your 50s or 60s, it is a protection and income mode. First, ensure to have an emergency fund of at least 12 to 24 months of expenses. Stocks, at 40 to 60%, should focus on dividend and value stocks. Bonds, at 30 to 40%. Real estate, at 15 to 20%, can provide rental income. The goal now is income and security. After you have crossed your 60s, stability is the key. You would definitely want to have an emergency fund of more than 24 months. Stocks, 30 to 40% should be low volatility, dividend-paying stocks. Bonds, 40 to 50%. Real estate, 20 to 25%. At this age, preserve your wealth while earning passive income. Now, how to choose the right stocks. Growth stocks like Amazon, Tesla, and Google are ideal for young investors. Dividend stocks such as Coca-Cola and Johnson & Johnson provide stable income. Blue-chip stocks like Apple and Microsoft offer long-term stability. Index funds and ETFs like S&P 500 and total market ETFs are also great options. Other asset classes include bonds, such as U.S. Treasury bonds and corporate bonds. Real estate options include REITs and rental properties. Commodities like gold, silver, and oil are also worth considering. For those willing to take on more risk, crypto and alternative investments like Bitcoin, Ethereum, and startups can offer high reward. Alright, let's dive into building a bulletproof portfolio. Step 1. Start with a core portfolio. This should include low-cost index funds. Step 2. Add growth investments. Think tech, healthcare, and e-commerce stocks. Step 3. Include defensive assets like bonds and real estate. Step 4. Consider alternative investments. You might look at crypto, gold, or REITs. And finally, Step 5. Rebalance regularly. Adjust your portfolio every 6 to 12 months. Now that you have a clear investment roadmap, here's what to do next. Analyze your current investments. Define what your financial goals are. Create a diversified portfolio. Create auto transfers so that you don't forget to invest. Set a rebalancing schedule. And finally, stay informed about the economy. Did you find this helpful? Smash that like button. It helps the channel grow. Hit subscribe for more investing insights. What's your biggest investing challenge? Comment below. We'd love to hear from you. Thanks for watching and happy investing.